Is static delta hedging effective? Have you ever wondered if there's a way to manage options risk without constantly adjusting your position? Today, we are going to look at static delta hedging and its effectiveness in options trading. Static delta hedging is a strategy that aims to reduce the risk of an option position without the need for continuous adjustments. Unlike dynamic delta hedging, which requires frequent buying or selling of the underlying asset, static delta hedging uses a fixed portfolio of options. So, how does static delta hedging work? It starts with constructing a hedge at the beginning using a small number of options, usually 3 to 5 call options. These options are selected based on their maturities and strike prices to offset the risk of the option position being hedged. This hedge remains unchanged throughout the life of the position, making it simpler than dynamic hedging, which needs constant rebalancing. Now, let's talk about how effective static delta hedging can be compared to dynamic delta hedging. Research shows that static delta hedging can outperform traditional dynamic delta hedging in specific situations. For instance, studies indicate that static hedges made up of a few shorter-term call options can significantly reduce hedging errors compared to daily adjustments in dynamic hedging. Metrics like standard error and mean absolute error show that static hedging can lead to more precise risk reduction. This effectiveness is particularly noticeable for options with shorter maturities, such as 2-month call options. Static hedges using 3 to 5 1-month options can reduce hedging errors by half compared to dynamic delta hedging. For longer maturities, static hedging still performs well, but its effectiveness may decline slightly as the maturity gap widens. What are some advantages of static delta hedging? First, it reduces transaction costs. Since the hedge is set up once, it avoids the high costs associated with daily rebalancing. Second, it requires less active management, making it more practical for some traders. Lastly, static hedging tends to perform better in jump markets, where the underlying asset price experiences sudden large moves. However, there are limitations to consider. The effectiveness of static hedging relies on choosing hedging options with maturities that closely match the option being hedged. If there is a mismatch, it can reduce the performance of the hedge. Additionally, static hedging assumes certain market behaviors and may not be as effective if volatility or other factors change unexpectedly. Designing an optimal static hedge can also be complex, requiring careful selection of option strikes and maturities. For traders involved in stock options, static delta hedging provides a way to manage directional risk without constant portfolio adjustments. It is especially useful when transaction costs are high or when a trader prefers a set-and-forget approach. However, it is essential to ensure that the static hedge is well constructed and reviewed periodically to maintain its effectiveness as market conditions change. In summary, static delta hedging is an effective risk management strategy in options trading. It often outperforms dynamic delta hedging in reducing hedging errors, particularly for short-term options. Its benefits include lower transaction costs and less active management, though careful setup is necessary to ensure success.